Welcome to the Eversheds Sutherland Webcast, Open Banking and the Future of Financial Technology. Before we begin, we'll start with a few housekeeping notes. CLE credit is approved for this webcast in California, Georgia, New York, and Texas. CLE credit is pending in Illinois and Virginia. If you would like to receive CLE credit for this webcast, download the CLE sign-in sheet and evaluation form from your viewing console and follow the instructions for submission. During the webcast, we will provide a confirmation code for you to enter on your sign-in sheet. This webcast is being recorded and will be posted to www.us.eversheds-sutherland.com within the next week. If you have questions during the webcast, please submit them in the Ask a Question box on your viewing console. I will now turn things over to Bob Pyle, partner at Eversheds Sutherland and head of the firm's U.S. Payments and Digital Commerce team.
Thank you very much, Sarah, and good morning or good afternoon, everyone, and thank you for joining this webcast. I wanted to give just a few words of introduction about the program itself and about our presenters, then I'll turn it quickly over to them. The title of the program, as you know, is Open Banking and the Future of Financial Technology, and I thought it might be useful to give you a little bit of background on how we came to this program. Our payments team, which consists of 20 professionals, both in the U.S. and internationally, we meet regularly, we talk about issues, and one of the things we were doing was comparing and contrasting the U.S. and the European approaches, noting in particular, frankly, how far ahead Europe was in terms of the structure in which it was advocating open banking. And this was in light of the July 2018 U.S. Treasury report called A Financial System That Creates Economic Opportunities, Non-Bank Financials, Fintech, and Innovation. And we thought there might be some lessons learned here from the European approach about what's coming in the U.S. and what we might do and what type of innovation we might all advocate for. So with that in mind, we came up with this program, which will be a bit of a compare and contrast, a little bit of crystal ball gazing about what the future holds here in the U.S. Our presenters, we're very fortunate to have some very well-credentialed presenters who advise on these issues all the time. Of course, they're in private practice now, but their backgrounds also include stints in government and banking. And from the international team, we have our UK partner, Richard Jones, and senior associate, Ruth Fairhurst. And in the US, we have partner Brian Barrett and special counsel Hannah Winiarski. I'll turn it over to Brian in just a moment, but as a note to the attendees, we will have a Q&A session at the end. We'll save some time for that. But we would welcome, whether it's in the form of the Q&A or as a follow-up to this conference, any questions you have or any follow-up discussions. We'd like to be of service any way that we can. So with that, over to you, Brian.
Thanks, Bob. Well, what is open banking? Open banking can be defined as a model in which banking data is shared through something called an application programming interface, or API, between two or more unaffiliated parties in order to deliver enhanced products to the marketplace. It really opens the way to the delivery of new or enhanced services to consumers and small to medium-sized businesses. It can also give consumers a better understanding of their accounts and financial information, helping them to manage or make the most of their money. On a technical level, open banking often refers to the UK version of an EEA regulation called the Second Payment Services Directive, or PSD2. This European rule requires some banks to make available certain customer data to third-party service providers. And here we're talking about fintech companies or data aggregators or other third-party services. PSD2 requires banks to make available some data to third parties. Open banking in the UK dictates that they do so in a standard format, which we'll discuss. Second, we'll provide a survey today of how U.S. regulators at the federal and state level have addressed the issue of access to a consumer's financial data. Third, we'll discuss the opportunities and challenges that open banking offers for market participants. And when we talk about market participants really mean, first, the banks and other financial institutions that access and use consumer financial data. Second, fintechs or other third-party service providers. Third, data aggregators and data brokers. And these are the intermediaries between third-party service providers and the financial institutions. And finally, the consumers. We'll ultimately touch on other related developments too. Hannah, could you get us started by providing some examples of open banking in the U.S.?
Sure. We'll have Richard and Ruth get into the nuts and bolts of the open banking implementation a little later on, but just to give a quick example to get us started, and this was an early mover in the area, is the app Mint, which allows a customer to categorize transactions and create budgets, see spending patterns over time, and in effect make use of their financial data in new ways. And that's made possible, of course, by Mint having access to the customer's underlying bank account data. And of course, that access is available now in the U.S., and there are providers accessing bank account data and providing all sorts of services and apps. Really, a differentiator with open banking, as Brian mentioned, is that the bank is required by regulation to make the information available and has to do so through a secure, purpose-built interface. And we'll discuss these different modes of access, API and screen scraping later on. But Brian, I'll hand it back to you to bring us up to speed on why this UK initiative is relevant now to us in the U.S.
Well, that's a good question, since the U.S. doesn't have a rule like PSD2. But it's important to discuss open banking here for several reasons. For one thing, our global clients have to follow rules in both the EEA and the U.S., and they're tackling the best way to address these issues outside and inside the U.S. As Bob mentioned, we can learn a lot from the experience in the UK and Europe, what works and what doesn't. Second, many consumers prefer to use fintech apps rather than an app offered by a traditional financial services provider. Retaining existing customers and adding new ones is an existential issue for banks and other financial institutions. Third, there's a public debate in the U.S. regarding who has the right to use a consumer's personal data for purposes of targeted ads or for marketing to provide enhanced services. The debate is led today by large technology companies such as Apple, which you may have seen has called for federal privacy regulation. So the issues of access to a consumer's personal data and how that data can be used, sold, stored, are similar whether one focuses on data accessible via smartphone or data accessible via a bank's API. How these issues of access, privacy, security, and consumer rights are addressed with respect to iPhone data may have direct consequences for how consumer financial data is accessed, used, stored, and sold. Just in the last few weeks, Facebook offered to pay $20 a month to consumers under 35 to install VPNs that would permit Facebook to hoover up their data from iPhones. Apple retaliated against Facebook and precluded it from happening. And just last week, Cisco called for GDPR-style privacy regulation to be adopted in the U.S. So there are a lot of good reasons to talk about this topic today. Richard and Ruth, can you summarize for us the state of play regarding open banking services in Europe?
Thanks, Brian. Great to have the chance to speak to everyone today. So, a big part of today's session we thought would be to share some lessons learned with you from a European open banking perspective. There are, of course, many open banking regimes springing up around the world, including in India and China, but seeing as the European regime is currently one of the most developed, we'll be concentrating on that today to discuss some of the lessons learned. As Brian has already touched on, there's a new regulatory regime which has come into force in Europe called PSD2, which mandates what we're calling open banking over here. PSD2 has come into force primarily to drive competition and innovation, and now regulates and gives access to certain new types of payment service providers, which will primarily be provided by fintechs and non-bank PSPs. From a European perspective, our focus today is on one of the newly regulated services called account information services. The providers of those services will offer an online service which provides banking customers with consolidated information on payment accounts which they hold with various payment service providers. So the third-party provider will use their new access rights that are hardwired into European law to get customers to sign up to the services, and then they'll request the customer information from the banks, and then they'll go on to do increasingly innovative things with the data which they've collected. We'll go on to some of the detail on those innovations later on in the session, but at a high level, the services will use transactional data to help users build a full financial picture in one place and help highlight where they spend, how they can save, and identify which financial services might be most relevant and suited to the user in the marketplace. We may see payment capability overlaid on top of those information services to enable users to move money around the ecosystem in one place rather than having to visit and get in touch with multiple account providers when they have accounts with different institutions. Although the institutions will need an additional permission from the regulator if they're going to do that within Europe. And then the final thing probably to say for a moment from a high-level introduction would be we'll see these services both created for consumers and for business customers. In the business world, open banking will give rise to new ways of businesses managing their finances and having tailored products that are tailored to their needs, rather than signing up for retail products or those more suited to specific or bigger corporates. I'll now pass back to Hannah to talk a little bit about further implementation of open banking and what's driving open banking in the US.
Thanks, Richard. And of course, Richard and Brian touched on this some, but open banking is certainly not occurring in isolation. It's part of a broader trend pushed along by technology and changes really in the way we bank based on the availability and importance of data available in customer bank accounts. So that's sort of the technological side of it. One other aspect is sort of changing ideas about the customer's right to his own data. And we see this reflected all over the world, really, in not only PSD2 and the GDPR, but other initiatives. Richard mentioned India, which is also not only have an open banking style regime coming into play, but has a new real-time payments network called UPI that's really revolutionary, and that it allows any Indian individual with bank accounts and access to this UPI interface to make a payment to any other person or business in the country in real time, which is something we are currently far from in the U.S., but I think working towards. But another factor, particularly in the U.S., is the concept of financial inclusion. And you see this reflected in the Treasury report that Brian's going to discuss in a few minutes. But making financial data more readily available to consumers, particularly those with thin credit histories, people who may have been unbanked or underbanked in the past, might help them qualify for mainstream financial products like mortgages. And there's actually an app out there now with the purpose of mining bank account data to find evidence of rent payments and thereby make those rent payments visible to a bank that, for example, may be reviewing a mortgage application. And then in addition to these broader drivers, open banking can be seen as generally a way to benefit consumers by pursuing the specific goals of increased competition in the marketplace, bringing new products to market, and simultaneously lowering costs for consumers. And the competition we're talking about really throughout is primarily between banks and non-banks, banks previously having had a gatekeeper role with respect to customer data and now making that available increasingly available to third-party service providers. But looking to the next slide, Richard, can you fill us in a bit on the nuts and bolts of the UK implementation of open banking?
Thanks, Hannah. Yeah, of course. So just to re-emphasize, okay, open banking in Europe is, of course, based on a mandatory regime. It stems both from PSD2 at a European level, and for the 9 biggest banks in the UK, we have some similar UK-specific legislation that's aimed at driving competition in the banking sector. Okay, so we know that open banking is mandatory, and we know that that's the reason we've got these basic access rights for TPPs, and we've got newly regulated payment services coming into existence. But one important thing to note is if the regulators just stop there, the regime would be implemented in various different ways. Certain banks may access, certain banks may have an impact on how open banking providers access the services, potentially making it more difficult for them. We might see impact on innovation and customer confidence, understanding and choice would suffer. Therefore, if open banking is going to be a success, European regulators and industry groups and associations have realized that what they need to build is consistency and trust. From a user's perspective, the users of the services want to know that how their data is being used, and also that their information is secure. And from a fintech, so TPP's perspective, they need to be able to develop business models and processes that can operate in the same way when interacting with a wide variety of banks and card issuers across the market, rather than needing to build bespoke processes per issuer or bank. They also need a regulator which is supportive and creates a regulatory regime that doesn't stifle innovation. At this point, we just thought we'd pick 3 specific points relevant to open banking, particularly in the UK. We'll talk to you a little bit about the FCA sandbox, and then we'll go on to mention some of the market standard interface initiatives that are developing around Europe, and also touch on the relevant players in the market and how they're being affected. So to pick up first on the FCA sandbox, to give you some context to this, late in 2016, the UK regulator announced a first group of companies participating in the sandbox. The initiative was its first, well, as far as we're aware, the initiative was its first of a kind globally and sparked a series of worldwide regulatory bodies to set up similar initiatives. The sandbox allows companies with innovative products to work with their regulator to test their products in a live environment, and it promotes competition and also, particularly importantly, increases the regulator's understanding of these innovative products. And that hasn't always been there, at least from a UK perspective. From our experience, talking to our colleagues in various countries, the sandbox is probably one of the biggest steps any regulator has taken to combat the disconnect between regulation and technology. Traditionally, product launch routes have been challenging for fintech firms or even banks developing innovative new products whilst they're in a development phase. What can follow is long periods of uncertainty, and during those periods, the market advantage of the new product that was potentially there could be lost to competitors in other jurisdictions with less rigorous regulatory frameworks. And a particularly noteworthy point at the moment, of course, is the importance of financial services in general and promoting fintech, in particular in a post-Brexit UK economy, is obvious to us. So we're seeing increasingly more emphasis in this area, and are now into round 4 of sandbox applications over here, and seeing more and more applications from fintechs. I'll now pass over to Ruth, who's going to talk a little bit about the open banking standard interfaces, and then go on to discuss the various parts of the ecosystem that are being affected.
Thanks, Richard. Well, Richard's touched upon the mandatory nature of the regulatory regime we have over in the EEA. However, it is worth flagging that what we don't have is a mandatory specific API standard. Instead, ultimately what we have over here is a framework or base requirements for how access needs to actually be given to third-party providers. And this was hotly debated throughout the implementation of the regulation, because regulators and others were keen to create unity across the market and to reduce fragmentation. And of course, existing third parties in the market didn't want to have to build back-end solutions which fit with lots of different specifications. However, from a balance perspective, what we ended up with was this base set of requirements instead of a mandatory standard. So what we've seen in place of that now is a number of European initiatives developing a specification for banks and third-party providers to use. From a UK perspective, we have a body called the Open Banking Implementation Entity, and they're developing a standard that the 9 biggest banks in the UK must follow. But smaller banks and, of course, other banks around Europe, they have more freedom to develop their own interface or to sign up to other market initiatives, such as the Berlin Standard, which is one which is popular across Europe. And Richard's going to talk shortly about the impact of open banking today on the UK market. But before passing over to him, it's also worth us just touching upon who open banking is affecting in the market and the main focus of their work. And I would say there's 2 main streams of work really across the UK and EEA. One which I would call comply and one which I would call compete. So comply, well, the need to comply with the mandatory regulation is meaning a lot of work for account providers over here, such as the banks, because they need to build compliant interfaces, they need to amend existing systems and processes, and from a legal and compliance perspective, a lot of work has been done over the past few years to actually understand the intention of the legislation and the requirements of the regulator. And touching on this really, because if a similar regime was put in place in the US, a more mandatory regime, to give you an idea of the impact this is having on account providers in the market, for a lot of them this is their biggest internal project. It's requiring the most changes to their systems, and it's taking up significant manpower and time. Then we've got the compete work stream, which is affecting a really broad range of providers across the market. Hannah mentioned existing providers in the US market, such as Mint at the moment. And in the UK and across the EEA, where we have existing providers, they've previously based their business models on screen scraping, and now they're going to have to change those processes and models to fit with the new specifications. So there's lots of work being done there. We've got new fintechs springing up, developing new products, but we also have a real change and push for innovation from incumbent providers such as the banks, because for them there's a real threat of disintermediation here and a loss of revenue, because of course if customers can access all their information through a more innovative product elsewhere, they may no longer access their online banking, for example, with a particular bank. So we've seen lots of them launching their own products, and we expect to see lots more competition over the coming year to become the leader in this field. I'll pass back to Richard now, who is going to talk a little bit about the success that the regime has had to date.
Thanks, Ruth. Okay, so we're a year into the first stage of open banking now in Europe, but the full regime doesn't launch until September. We've seen a large number of applications to the regulator, at least in the UK, from fintechs who want to provide the new regulated services. We've also seen some of those providers using the regulatory sandbox to test their solutions that I mentioned earlier on. We're also aware that there's a real consumer appetite for innovative retail financial products that enables a customer to better control their spending. And we're also seeing the increasing development of innovative products. So we know we have a lot more competition. We know that there's a need for the products coming to market, and we know innovation is growing. All of that, of course, to make it a success, needs to come together, though. As this happens, take-up is something we feel we will see more of during the course of this year, particularly because September is the deadline for the full-scale launch of European open banking. At this point, Ruth's going to talk to us a little bit through some of the most interesting players and use cases we've seen in the market. Before we do that, we can of course assure you that none of our team have any stock in any of these companies that Ruth's going to go and mention. We just think they're interesting examples to showcase some of the open banking solutions which are developing. Ruth, I'll hand back to you.
Thanks, Richard. Well, Richard mentioned earlier the most kind of typical type of account information service, which is essentially an enhanced aggregation service. But we've seen real innovation across the EEA in terms of the way open banking is being used. So I wanted to touch on three different aspects of it, which should be of interest to those joining. So one area we're seeing institutions use open banking data for is to streamline their customer journeys and onboarding processes. And they're doing this because they can pull data from other banks and pre-fill aspects, essentially, of their customer journey or the online application process, which saves the customer time and ultimately, decreases dropout rates and it increases conversion rates for them. And the other thing is they can then use the knowledge that they've gained from the way the customer has used their account elsewhere to target tailored products and services at their customers. Another area we're seeing real developments is in credit checking. So to give you an example, we've seen a company called Castlight, and they have an affordability passport. And what that does is it uses open banking data and allows a customer to share a picture of their income, a picture of their expenditure, and their financial capability across accounts, which really opens up credit to them if they have, for example, a very thin credit history file and wouldn't normally be able to obtain credit. And this is one that's being piloted with lenders and banks across the market through Castlight. because it allows those lenders and banks to offer credit to a wider range of customers, and it helps them support existing credit scoring processes. Thirdly, I just wanted to touch upon another innovative offering, which is companies which are offering loyalty schemes and discounts in conjunction with merchants to retail customers. So again, an example of this would be Flux. And what they do is they allow retail customers to link exactly what they buy through their various checking accounts with the Flux app. And the app then provides them with a digital receipt and also loyalty points, because Flux has partnered with retailers and merchants to offer discounts and loyalty schemes, which automatically load onto the app whenever they make a purchase. So I'll pass over now to Brian, who's going to talk a little bit about the US regulatory environment.
Thanks, Ruth. Before I do that, I just need to mention that for those of you who would like to receive CLE credit for today's webcast, our confirmation code is regulation. Again, that's regulation. Please use it for the sign-in sheet available for download from your viewing console. So back to what's going on in the U.S. So in the U.S., market players are operating today largely in a regulatory vacuum. There's no legal rule requiring a bank to make a consumer's financial data available to a third party if a consumer provides consent to do so. So for now, banks and other financial institutions are largely determining the rules of engagement. Outside banking, by the way, one sees the large tech and ad companies such as Google, Apple, and Facebook effectively determining the rules of engagement in the U.S. In the Dodd-Frank Act, Congress did instruct the CFPB to implement consumer financial law for the purpose of ensuring that all consumers have access to markets for consumer financial products and services, and that markets for these products and services are fair, transparent, and competitive. In 2017, the CFPB published Consumer Protection Principles. The principles are aspirational in nature. They don't establish any binding requirements, and they don't change any privacy, security, or consumer protection laws. There is currently no expectation that the CFPB would adopt any rules in this area. We'll quickly run through some of the consumer protection principles now because it's really a good laundry list of some of the relevant issues. The first principle is consumer access. Here, consumers should be able, upon request, to obtain information about their use of a financial product or service from their bank or other service provider. Consumers should be generally able to authorize third parties to obtain such information from banks or other account providers. Notably, access does not require that consumers share their account credentials with third parties. Another principle addresses data scope and usability. Under these principles, not all data would be accessible. Financial data subject to access by third parties would include fees or interest paid and consumer benefits such as interest earned or rewards. Regarding usability, information should be made available in forms that are readily usable by third parties. Third parties should have authorized access only to the data necessary to provide the products or services selected by the consumer. Third, the principles include a principle with respect to informed consent. Here, authorized terms of access, storage, use, and disposal should not be overly broad, and consumers should be able to readily and simply revoke authorizations to access, use, and storage. You might have guessed that one of the principles relates to security. In short, all parties that access, store, transmit, or dispose of data should use strong protections to mitigate the risks of and remedy data breaches unauthorized access and fraud. Another principle relates to transparency. Consumers should be informed of which parties they have authorized and are accessing or using consumers' accounts. Consumers should have reasonable means to dispute and resolve instances of unauthorized access and data sharing. Finally, it is worth mentioning that the principles call for commercial participants being accountable for the risks, harms, and costs they introduce. This is certainly a non-controversial principle. Shifting gears now from the CFPB's principles to the Treasury Department, as Bob mentioned at the outset, the U.S. Treasury last summer issued a report on non-bank financials and fintechs. If you take a look at the report, you'll see that the Treasury made a series of recommendations on open banking issues. Given the limited time, I just want to mention one of these. Treasury says that it sees a need to remove legal and regulatory uncertainties currently holding back financial services companies and data aggregators from establishing data sharing agreements and effectively move firms away from screen scraping to more secure and efficient methods of data access. Treasury says that the U.S. market would be best served by a solution developed by the private sector with appropriate involvement of federal and state regulators. Some of the states have been active in addressing some of the issues we've been discussing. And Hannah, can you tell us some of the things you're seeing there?
Sure. Thanks, Brian. And, state privacy laws and really the federal equivalent, the Gramm-Leach-Bliley Act, become relevant to the issue of allocation of compliance responsibility and liability for potential breaches and data loss that we've discussed earlier. But the movement I'm seeing in terms of state privacy laws, and I'll keep this fairly brief, is really a movement from more defensive sort of statutes that require notification once a breach has occurred to more proactive statutes modeled more on the GDPR, which give the consumer really more of a sword with respect to their data, knowing who has it and being able to more proactively limit how that data is used. And California, as always a leader in this area, has a statute that's on the books to go into effect in 2020 that's really modeled on this GDPR style of regulation. But moving on from the privacy statutes, I'm going to keep these last 2 points fairly brief. I could talk about this for a long time, and I've been accused of that in the past. But one issue in terms of competition in the United States between banks and non-banks is that non-bank services providers, particularly those who offer some type of payment service, moving funds from one place to another, one person to another for compensation, fall under state statutes that govern money transmission. And those statutes carry with them a licensure requirement and supervision by the state banking authority. And both of these, particularly the licensure piece, present a large upfront obstacle for fintech operators who want to do payment services and who are not banks. So this is sort of being addressed in two different ways, really conflicting ways, at the federal and state level. The OCC has started accepting applications for what it's calling a limited purpose charter for non-depository fintechs that would essentially give them national bank status, and with that, importantly for lenders, exemption from state interest rate caps, and also the ability to preempt any state licensure and supervision requirements that apply to money transmitters. So that's subject to some legal controversy as to whether the OCC actually has the statutory authority to do that, and very much uncertain as to how that controversy will be resolved. And then on the state side, you have the College of State Banking Regulators, which have an initiative called Vision 2020, and what they're trying to do is establish a uniform licensure platform for money transmitters to remove the duplication and some of the time-consuming nature of these applications for state licenses, which are really at this stage, in large part, one-off concerns, where the applications will certainly overlap a great deal, but no state license provides exemption from any other state's licensure process, and they all have great leeway to apply their own statutory requirements as they see fit in a prudential sort of way. So similarly to the OCC charter, we don't know how this one's going to turn out. So far, 7 states have signed up. Their goal is universal adoption by 2020, which is very ambitious. But it is indicative, I think, of the state of play in the U.S. that this hurdle that faces non-bank providers who want to offer payment services is seen as important enough that it's being attacked really from both sides, state and federal at this point. But moving on to the next slide and turning it back to you, Brian, can you give us an idea of some of the opportunities and challenges you're advising your financial services clients on now in light of the impact of open banking?
Sure, Hannah. I'd like to take a deeper dive on a few of the key issues for the large banks, data aggregators, fintech, and consumers. First, the topic of consumer consent. This means that consumers have to provide explicit consent for access to and use of their data. And the market participants have sharply divergent views of what the scope of this consent should be. The debate really is around possibly limiting the scope and the duration of a consumer's consent. Consumer groups point out that consumers may believe that they're providing access only for purposes of a narrow range of transactions or services, but a bank or third party can gain access to a wealth of information about the consumer's income, purchases, spending patterns, and other sensitive information. These groups point out that a bank or data aggregator may use the information for targeted advertising or marketing purposes, or sharing or selling it to other parties that the consumer really has no knowledge of. Another topic that often is discussed in the same breath is a consumer's right to revoke consent. Here the notion is that the consumer should be able to easily turn off the sharing of information. And again, the data aggregators, fintechs, and maybe even the large banks would be more constrained in using, sharing, and selling the information if the consumer could turn off the sharing. And related to this is the notion that only the minimum amount of data required for a particular app should be collected, and the data should be stored for the minimum amount of time. According to some consumer groups, a consumer should have the ability to opt out of a broad sharing of data. So the scope and duration of authorized consent is a topic, by the way, on which Jamie Dimon and Tim Cook may agree. Dimon put it this way: in the future, he said, instead of giving a third party unlimited access to information in a bank account, we hope to build systems that allow us to push information, and only that information agreed to by the customer, to that third party. Richard, what has your experience been with consent issues and similar issues there?
Thanks, Brian. We've probably got a couple of quick things to mention from a European perspective. First of all, in terms of the consent for the new regulated services, it's been made very clear from a regulatory perspective that the consent needs to be obtained from the customer by the new open banking service provider, and also it can't be checked by the bank before they grant access. And secondly, the banks aren't able to create a facility to revoke the consent. So, for example, there can't be an option in the customer's internet banking channel or mobile banking app to allow the customer to cancel the consent that they've previously given to the open banking provider. The thinking behind that is if banks could involve themselves in this process, it might negatively impact fintech businesses building account information service offerings. Brian, is that back to you to talk about allocation of liability?
Yeah. So on allocation of liability, the big question is liability for a security breach. In the U.S., generally speaking, there are no laws that clearly allocate liability for a data breach with respect to the information that consumer wishes to share. Such liability is largely allocated by private contract between banks and third parties. In the case of high-profile breaches, we've seen that liability may also effectively be determined by federal or state regulators or attorneys general applying consumer protection laws, including those addressing security breaches. An interesting aspect of the discussion of liability here is that a trade association that represents large U.S. banks has taken the public position that aggregators are financial institutions and should be directly supervised and examined as financial institutions. Failure to make existing consumer data privacy and security laws explicitly applicable to data aggregators, according to this trade group, has the consequence of making the banks the banks and other account holders ultimately responsible for the mitigation of consumer risk introduced by third parties. Any open banking legislation that may ultimately be adopted here may carry with it the consequence of greater regulation of non-banks. I would also note that in 2014, different administration, the FTC recommended that Congress consider enacting legislation that would enable consumers to learn of the existence and activities of data aggregators and provide consumers with reasonable access to information held about them. Currently, there is little regulation in this area aside from the Fair Credit Reporting Act. This may change, maybe in another administration. Ruth, I understand that some data aggregators in the EEA are now subject to regulation. What has been the situation there?
Thanks, Brian. Yes, I mean, I guess there's a fundamental point now with the introduction of PSD2. Data aggregators, will generally fall within the scope of the Payment Services Directive. And from a liability perspective, we saw some really difficult issues being debated across the EEA, right back to the development of the regulation very early on. There was a lot of lobbying around the liability position because, of course, regulators wanted to protect customers from being exposed to loss as a result of new services. They wanted to bring these types of providers within the scope of regulation to make sure that that customers were adequately protected. But the banks and other account providers were concerned about taking on additional responsibility for loss here because, there's a third party involved and they have no control over what that third party does, particularly in terms of once the data is sat with them. What we ended up with from a regulatory perspective in terms of payment services in the EEA is that where there's an unauthorized transaction, essentially, the account provider has to provide a refund to the customer and then seek to recover from the third party behind the scenes. And they do have a right of action to do so built into the legislation. But of course, what that doesn't really deal with is how you decide who is responsible where the parties don't agree and whether or not it's actually worth using that right of action, depending on the amount of loss, for example, and whether you really want to litigate over it. As well as that, of course, there could be data breach issues under data privacy law. So we do have a much wider regime over here as a result of bringing those data aggregators within the scope of regulation. That's back over to you, Brian.
Thanks. I think Hannah's going to talk a little bit about open APIs versus screen scraping.
Yeah, thanks, Brian. And I'll keep this fairly streamlined. We've covered this to some extent already, but really the API versus screen scraping issue is sort of one I think of as being sort of a blunt versus a precision instrument. The screen scraping method being somewhat of a blunt instrument in that it just sort of gives the financial services provider access to all of the information the consumer could see without really any built-in mechanism to limit it other than the consumer simply changing passwords. Whereas API is much more subject to a user permission and limited scope. But really the issue of API versus screen scraping sort of presents differently depending on where you're standing in the market. For banks, API really allows them to continue to be a gatekeeper to some extent of data, and that they have to participate with the third party in providing the data or seeing it outflow from the customer's account. And for banks, I think API also reduces some of the system stability concerns they have about, multiple close-in-time requests from third parties for data causing their systems to become unstable. And they've loudly voiced these concerns. And actually, many banks' terms and conditions actually prohibit customers from giving out passwords, and in some cases tried to pass on responsibility for loss due to those passwords having been handed out back to the consumer. Query whether that works at all, but banks are certainly very sensitive to that issue. If you look at from a fintech side, they're seeing screen scraping as being preferable because it doesn't require the bank to participate. Many fintechs see banks as being hostile to the idea of the third party gaining access to the data in the first place. It's readily available and doesn't require any real meaningful interaction with the bank. And if you look at consumers, I think there's increasing awareness maybe of the security concerns of providing passwords, but in the U.S. at least, providing credentials is really sort of seen as a cost of obtaining a useful app or service. Not that there aren't alternatives. There are some initiatives by even some banks to try to make APIs more widely available and provide that secure access. But as of now, screen scraping is still the primary method. But Brian, with that, I'll turn it back over to you to talk for a minute about what you're seeing in the U.S. financial services market now.
Thanks, Hannah. Well, here's some of what we're seeing. The ability of third parties to access consumers' financial data really rests almost entirely with the inclination of the user's financial institution. And not all of the large banks are disposed to allow permission to third-party tools. Like any business, the big banks want to retain their customers and revenue streams. They often have no commercial incentive, and in fact, commercial disincentives to permit access. A few large banks, such as Wells and JP Chase, have struck bilateral agreements with data aggregators and software providers when it makes commercial sense to do so. JP Chase's agreement with Intuit and Wells' agreement with Xero are examples. A small number of banks, including Silicon Valley Bank and Cap One, have embraced open banking and do offer APIs. Large banks are also funding and acquiring fintechs to be able to provide the apps demanded by consumers. We've spoken largely about the largest banks. If you look at the mid-sized and smaller banks, the cost of providing an API is an obstacle, and another hurdle is that they often rely on third parties for their core banking platform, and these systems providers may not be embracing open banking. If you look at the data aggregators, fintech firms, and consumer groups in the U.S., the view of many is that the lack of an open banking regulation really hampers financial innovation to the detriment of consumers. They complain that even with consumers' consent, they must negotiate with banks to gain access to the information they need to deliver apps and products that could help consumers manage their finances. Even the Treasury Department said that access is frequently and unilaterally restricted, interrupted, or terminated by financial services companies. Fintech's criticism includes that a consumer may be forced to navigate confusing interfaces that require certifications or to specify the types of data for which it's requesting access in the format in which it's requested. What is the way forward on these issues in the U.S.? Well, as the physics students among you know, nature abhors a vacuum, and the regulators in California and New York seem to also abhor a regulatory vacuum. They may make the issues of consumer access and the use, sale, and storage or deletion of personal financial information a top priority. This may really incentivize federal legislation to preempt conflicting state rules. But this is really only conjecture. Hannah, any other developments worth mentioning?
Just briefly, we are seeing a lot of work around developing standard APIs, and in a sense, trying to, I guess, mimic the benefits of what the UK has achieved with open banking without, as you said, a top-down type regulatory regime to work from. So we see a group backed by NACHA, which is the ACH payments network in the U.S., working on different use cases to find standardized APIs to fit different industry problems. But again, that's very much grassroots rather than top-down. And, we're also seeing some work around the real-time payments network here in the U.S., or the lack of one, or the desire for one. The Federal Reserve recently put out a proposal to get involved in real-time payments and also to provide a liquidity service to try to sort of mitigate some of the liquidity concerns that come with having to settle in real time. But I think you've broadly covered the state of the market today, so I think I will then hand over to Richard to get some idea of what are some of the problems and issues that they're seeing since open banking went live. That may give us some sense of what we could expect here in the U.S. if we do arrive at some sort of open banking equivalent.
Thanks, Hannah. Okay, we'll just do a quick fire run through of some of the other interesting issues, challenges that we've seen. The first point is in relation to access. A couple of things to talk about there. So who is obliged to provide the access? It's not just the banks, it's any provider of accounts that are accessible online. So it could be checking accounts, savings, credit cards, prepaid cards. And is there a certain level of access that needs to be provided by the banks to the third-party providers that's guaranteed in the EEA? Well, yes, to some extent. There's no mandatory list, but what the banks need to do is provide the fintechs, the TPPs, with the same level of information which is available to the customer if they're accessing their account directly. So seeing as different account providers will offer different amounts of information, the amount of information will differ from account provider to account provider. Ruth, you just got a couple of other interesting points to mention.
Yeah, sure. Thank you, Richard. One point we thought worth mentioning relates to contractual relationships. And what we have now in the EEA is a restriction on banks putting in place contracts with third-party providers in relation to access. Even though those contracts could have been in place historically, of course, to facilitate access before the regulation came in over here. That restriction is in place, but we are still seeing contracts spring up. So in particular areas, which is essentially where either both parties still want to partner with each other, so they do it purely by choice, where the bank is offering something to the third party over and above what they're actually mandated to provide by law. So they're providing additional access, for example. Or where it relates to accounts which just fall totally outside of the scope of regulation over here. The final area just to touch upon from our perspective is authentication. And we wanted to touch on this because it's been such a challenging and hotly debated area across the entire of Europe. What we've got in the UK being taken forward is an authentication method based on redirection. So where the customer's redirected to their account with the bank to authenticate, then pass back to the third-party app or website. And we'd say, from a US perspective, this is certainly one to watch because it was so hotly debated. Many of the banks wanted to keep control of the authentication process. Some third parties felt this caused real interruption in their customer journey, leading to customer dropouts. So definitely a topic of a key topic to consider from a US perspective. So I'll pass over to you, Brian, now to wrap up.
Thanks very much, Ruth. So we have just a little bit of time for some questions, and one of the questions we've received really is about state money transmitter regulation. The question is, would some non-bank fintechs be more interested in a industrial loan company charter versus the OCC special purpose charter? Does the industrial loan company charter give them relief from having to comply with state money transmitter requirements and potentially be easier than the OCC charter? Well, the answer to that is there are numerous advantages to considering generally a state charter versus the OCC special purpose charter. For one thing, the OCC's regulatory capital requirements are going to be very different from any state banking department's capital requirements, and there are a host of other issues on which local state banking regulators would differ from the OCC's approach. And in terms of whether this would be an alternative to money transmitter license, that really is determined on a state-by-state basis. States generally have specific exemptions for state chartered banks. These exemptions may or may not extend to particular types of banks depending upon the state legislation, the state money transmitter law. So with that, I think we were about ready to wrap up. Does Hannah or Richard or Ruth have anything else to add at this point?
Just one thing to add on the ILC question. I think one issue there might be availability. I think only fewer than 10 states really offer that charter at this point. But based on what I've seen in the money transmission statutes, a lot of times you will see sort of a general carve out for institutions, chartered by the state as a bank or as a depository institution, language like that. So there may very well be some exemption from money transmitter statutes within the state. And then you've also got, obviously a benefit of the ILC being the ability to generally export interest rates, which is of interest to any fintech that's thinking of lending and could be subject to state interest rate caps. But that's all I have on that.
Brian,
we're out of time. Go ahead, Richard.
Brian, I was just going to say there's nothing else from a European perspective, but happy to answer questions after the session if anyone's got anything, whether it's from a European perspective or open banking regimes in India, China, or elsewhere. And
same here in the U.S. We're out of time, but if you have questions we haven't gotten to, please reach out to us. Thanks for your participation today.